Welcome back to the Deep Dive. Today, we're putting on our Talk Tickers hats, our special lens for cutting through the corporate jargon. And we're diving into the latest earnings call from SAP. This is for their second quarter and half year 2025 results.
Right. And it was quite a strong showing, especially given the persistent uncertainty out there in the global economy.
Exactly. How did they manage such a robust quarter? That's what we want to unpack today. We'll dig into the numbers, the strategy, what's really driving things.
It definitely felt like a quarter where things started clicking into place. You saw accelerating revenue growth, really impressive profitability.
Okay, so let's start with the headlines then. For listeners who just want the quick snapshot first, what really jumped out from the numbers?
Well, the big story, I think, has to be cloud revenue. It surged 28% year over year. That's at constant currencies.
28%, that's strong.
It is. And what's really insightful is that it's actually an acceleration. 2 percentage points faster than Q1.
Ah, interesting. So they're picking up steam there.
Seems like it. For a company SAP's size, seeing that kind of reacceleration in cloud is, it's a pretty powerful signal.
And within the cloud business, any specifics?
Yeah, the Cloud ERP suite, it just keeps going. Over 30% growth again. That's 14 quarters in a row now.
14. Wow.
And it's now, 86% of their total cloud revenue. So it's the core engine, a really solid foundation.
The consistency is definitely key. What about the overall picture? Total revenue.
That picked up pace too, reached 12% growth, hitting $9 billion for the quarter.
Okay.
And looking ahead, the current cloud backlog, that future revenue indicator, grew 28% to $18.1 billion. That's even with some currency headwinds playing against it.
$18 billion in backlog. That speaks to predictability, doesn't it?
It really does. They mentioned predictable revenues now make up 86% of their total revenue. That transition to subscription models has really de-risked the business profile.
That's a huge shift. Okay, predictability is good. But the bottom line, operating profit, that was a real standout, wasn't it?
Oh, absolutely. That really caught my eye. Operating profit soared an impressive 35% non-IFRS. That's $2.66 billion.
35%. Now, maybe just quickly clarify non-IFRS for everyone.
Sure. It basically means they adjust the standard accounting numbers to take out certain items. Things like share-based compensation costs or maybe charges related to acquisitions.
So it gives a clear view of the underlying business performance.
Exactly. It shows the real operational improvements, the impact of their transformation program on the cost base. It speaks volumes about the model's strength.
Got it. And profit's one thing, but cash is king, right?
Yeah.
How did the cash flow look?
Exceptionally healthy. Operating cash flow was up 71%. That's $2.66 billion.
71% increase.
Yeah. And free cash flow, even more impressive, up 83% to $2.4 billion.
Wow. What drove that surge?
Well, mostly higher profitability, as you'd expect, but also some positive working capital movements and lower cash payouts for things like share-based comp and restructuring. We can probably dig into that a bit more.
Yeah, let's do that. Let's unpack that profitability story. Because 35% profit growth isn't just about selling more stuff. What were the levers?
You're right. It's multifaceted. Strong cloud revenue growth was the main engine, obviously, but it got a big boost from expanding cloud gross margins.
Ah, efficiency gains.
Exactly. The cloud gross margin improved 1.8 percentage points. It's up to 75.2% now. That shows they're scaling those cloud operations really effectively.
Okay, so better margins on the cloud business. And you mentioned share-based compensation earlier. That played a role too.
It did, quite a significant one, especially in the first half. Those expenses were down $331 million compared to last year. That's a 26% drop.
That's a big swing factor.
It is, but there's a nuance here. It benefited from, let's say, easier comparisons. Last year, H1 2024 had a big headwind from certain cash-settled parts of the compensation.
Okay, so the comparison made this year look particularly good in H1.
Precisely, which means, for us looking ahead, that specific tailwind from lower share-based comp won't be as strong in the second half of the year. The comparisons get tougher.
Right. So it sounds like a mix of strong cloud performance, improving cloud margins, and some help from those compensation comparisons, all underpinned by cost discipline.
That sums it up well. The transformation program seems to be delivering tangible results on the cost side, making the business model more resilient.
Okay, good handle on profit. Let's go back to the cloud momentum. That Cloud ERP suite is clearly the core. But you mentioned the overall cloud backlog growth, while strong at 28%, did decelerate slightly from Q1. Just 1 point, but still.
Yeah, that's right. A slight sequential slowdown. Management addressed this directly.
What was the reason?
They pointed to elongated sales cycles, specifically in a couple of areas, the U.S. public sector and also industrial manufacturing.
Oh, okay. Macro factors creeping in.
Seems like it. Geopolitical stuff, uncertainty around trade policy. It's making some customers take a little longer to sign on the dotted line, especially for larger deals.
So crucial point here. Are these deals lost or just delayed?
Management was very clear. Not lost, just pushed out. So closing these deals becomes a key focus for the second half.
And the second half is usually bigger for them anyway, right?
Yeah, historically about 2/3 of their annual new cloud business lands in H2. So the pipeline coverage is apparently still strong, consistent with last year, but there's execution risk tied to converting those delayed deals. Depends on how those macro headwinds evolve.
Definitely something to watch. Okay, let's shift gears to innovation, because SAP is making a lot of noise about business AI.
They really are, and it seems to be more than just noise. Get this. Over half of their Q2 cloud order entry volume came from deals that included AI use cases.
Over half. Already, that's faster adoption than I might have expected.
It is quite striking. It shows AI isn't just a future thing for them, it's driving business now. And they're rolling out AI agents fast. They've released 14 already.
14 agents. Doing what?
Covering different business functions. So in finance, you've got agents helping with planning, calculating accruals, even spotting potential cash shortages.
Okay, practical stuff.
Exactly. And in supply chain, recommending suppliers, helping respond quickly if there's a disruption. They plan to have 40 agents out by the end of the year.
40 by year end. That's ambitious. What about Joule, their AI co-pilot?
Joule's evolving too. Big news is it'll be available across non-SAP systems starting Q3. That's through an integration with WalkMe.
Ah, so extending its reach beyond just SAP applications.
Right. Makes it potentially much more useful across the whole enterprise.
Yeah.
And in Q4, it's getting smarter, giving more comprehensive answers thanks to a partnership with Perplexity.
Interesting. And they also talked about the Business Data Cloud, BDC.
Yeah, that's another big growth bet. The pipeline for BDC is apparently skyrocketing was the word used, I think.
Skyrocketing, okay.
It was part of many Q2 deals, and it deepens their partnership with Palantir. SAP sees this becoming a multi-billion-euro business within a few years.
And how does it help customers? What's the value prop?
Essentially, it helps customers bring together and harmonize data from SAP and non-SAP sources, then build intelligent applications on top. They reckon it can uplift the value of their big RISE transformation deals by 20-30% in contract value.
20 to 30% uplift. That's significant. So better data leads to bigger deals.
That's the idea, unlocking more value from the data they already have.
Okay, let's talk strategic growth areas. The partnership with Alibaba in China really stood out. Feels like a big move.
It does. It's quite strategic, focusing on two main things. First, Alibaba itself is rolling out SAP's business suite internally. That's a huge validation.
A massive customer win, essentially.
Exactly. But maybe more strategically important, Alibaba is becoming a key partner for SAP's Rise and Grow offerings in China.
So helping SAP sell in the Chinese market.
Right. Tapping into that huge potential, both existing SAP customers and new ones. And critically, it helps multinationals navigate the complexities there, delivering cloud solutions in China for China.
That phrase, in China for China, really taps into this growing theme of digital sovereignty, doesn't it? Which seems like another area SAP is focusing on.
Absolutely. And they seem genuinely well positioned here. Their sovereignty cloud offering is quite comprehensive. They emphasize sovereignty over the entire stack.
Not just the infrastructure layer.
No, all the way up to the application. They offer features like guaranteed EU data residency, bring your own key for encryption control, even air-gapped solutions for maximum security.
Who's buying this?
It's gaining real traction, especially with defense contractors like Henselt in Germany and BAE Systems in the UK. It reflects that global debate about data control and national security.
Right, becoming a bigger and bigger issue. Beyond these big strategic plays, any other notable customer wins in Q2?
Yeah, they listed quite a few across different industries. GSK and pharma, Balmain and fashion, Replay, Gartner-Wide, Ecom, Nepco, MCH, Delta Airlines, BMW.
So a wide range.
Very wide. Even the German federal pension insurance, L'Oreal, and the German armed forces. It really shows the breadth of their appeal. They seem to be winning across the board.
It's interesting. They're not just selling AI, they're using it heavily internally too, right? You mentioned that transformation program earlier.
Exactly. They're really eating their own dog food, as the saying goes, showing the productivity benefits internally.
Like what? Any examples?
Yeah, they gave some specifics. Digital sales teams seeing productivity boosts up to 50% in some roles. HR service tickets getting resolved 20% faster using Joule in success factors.
Okay.
And even their own software developers are up to 30% more efficient using Joule.
So real measurable gains. And this helps them manage costs.
Precisely. It helps them decouple expense growth from revenue growth. That's key for expanding margins over the long term.
And this ties into their workforce strategy. It sounded less like big restructuring rounds and more like continuous adjustment.
That's exactly the picture they painted. Continuous workforce adjustment. It involves reskilling people, reducing roles where demand is lower, but also hiring significantly in areas like data science and business AI.
So constantly tweaking the mix.
Yeah, the management described it as like brushing teeth. Something you do regularly to stay healthy and avoid bigger problems later, like large-scale restructurings. And importantly, they said this ongoing optimization won't hit their non-IFRS profit numbers. It's strategic shaping, not just cost cuts.
And what does that mean for their operating leverage going forward, the relationship between revenue growth and expense growth?
They expect to keep that operating leverage, the increase in expenses, relative to the increase in revenue contained in the 80 to 90% range for the next few years.
Meaning for every extra euro of revenue, only 80 to 90 cents flows through as added expense.
Exactly, which signals continued margin improvement over time. They plan to keep getting more efficient.
Okay, so a lot of internal strength, efficiency gains, AI adoption. But what about the outside world? Are they acknowledging the macro headwinds?
Oh, yes, definitely. Despite the strong Q2, they were quite prudent, quite cautious about the macro environment. They specifically called out the ongoing uncertainty, especially around trade policy.
Which connects back to those elongated sales cycles you mentioned.
Exactly. They're not assuming clear skies ahead. They seem focused on controlling what they can control, profitability, cash flow, to navigate whatever the economy throws at them.
So given that mix of good performance but external caution, what did they do with their full-year guidance? Did they raise it?
No, interestingly, they kept the full year 2025 outlook unchanged across all metrics.
Holding steady then.
Yeah, it feels like a balance. Confidence in their pipeline, they said, coverage is similar to last year's very strong H2, but balanced with that caution about the external environment, not getting overconfident.
And there was one other factor affecting comparisons, something about WalkMe.
Right, a technical point for analysts mostly. The impact of the WalkMe acquisition on the cloud backlog growth rate phases out in Q3. WalkMe added about 1.5 percentage points to that growth in Q2.
So without that contribution, the reported year-over-year growth number for backlog will naturally look a bit lower in Q3 and Q4.
Correct. It's just a base effect, a tougher comparison, not a fundamental change in the underlying business momentum.
Got it. Okay, let's step back. For you, our listeners, thinking about the broader enterprise software space, what does SAP's story tell us? What are the signals here?
Well, I think it reinforces a few key themes. One, the drive to the cloud is relentless, and even huge legacy players like SAP can find ways to accelerate their transition. Two, AI is becoming very real, very fast, not just as a product feature set, but as a core driver of internal efficiency and productivity. Every company is looking for those gains now.
That productivity point feels crucial in this economy.
Absolutely. And three, related to that, the need for those productivity gains is pushing companies to be smarter about how they invest.
Which leads to procurement behavior, right? What signals did we get there from SAP's commentary on sales cycles?
Yeah. The mention of elongated cycles, and also customers breaking down mega deals into smaller, more manageable phases. That points to a cautious procurement environment across the board.
Oh, companies are still investing, but maybe more carefully, focusing on quicker ROI.
Seems like it. Prioritizing immediate value, de-risking those huge multi-year transformations, especially when the economic outlook is murky. Smaller bites, perhaps.
And finally, you touched on geopolitics earlier. It feels like that's creating some unexpected tailwinds.
It really does seem to be. The focus on in China for China, the strong demand for digital sovereignty solutions, particularly in Europe's public sector and defense. These are significant trends.
So companies that can offer localized, secure, sovereign cloud options might have an advantage.
Potentially a very significant one. As nations get more focused on controlling their critical digital infrastructure and supply chains, providers like SAP, who can meet those specific national requirements, could see growing demand. It's a macro trend playing out in the tech sector.
Okay, this is Talk Tickers, so you know what time it is. Our not financial advice segment. And we really have to stress this.
Louder for the people in the back.
This is not financial advice. Please, do your own research, make your own decisions. This is purely for discussion, maybe a little entertainment.
A thought experiment. Nothing more. Don't call your broker based on this.
Okay, disclaimer delivered. Here's a potential trade idea playing on some of these themes we've discussed.
Let's hear it.
Given SAP's strong commentary around things like Made for Germany, their obvious deep roots there, and this accelerating demand for digital sovereignty in Europe, especially defense and public sector, consider a long position in SAP. But view it not just as an enterprise software play. View it as a bet on SAP becoming the sort of indispensable digital backbone for Europe as it potentially reindustrializes and focuses more on sovereignty.
Interesting angle.
Yeah.
So less about global software dominance, more about becoming critical European infrastructure.
Kind of, especially as defense spending ramps up and regulations might favor local champions. And to maybe juice that idea,
Go on.
you could layer on a basket of European defense tech companies, the ones that would directly benefit from SAP underpinning their own digital transformations as they modernize and scale up.
So the thesis is that the European strategic needs sovereignty, defense, more than offsets, say, the drag from slower U.S. public sector deals right now.
That's the core of the thought experiment. National strategic priorities in Europe creating a powerful localized demand driver for SAP and related tech. Again, not advice, just an idea to chew on.
A spicy meatball of an idea. Okay.
All right, let's wrap up our deep dive into SAP's Q2. Overall assessment.
I mean, clearly strong results, driven by that robust cloud growth, really aggressive moves in AI, both selling it and using it, and very disciplined execution on costs and margins.
Yeah, the operational execution really shone through on the bottom line.
It did. And while those macro uncertainties are definitely still out there, SAP seems, pretty well set up for the second half. They're focused on momentum, sure, but also very clearly on protecting profit and cash flow, managing what they can control.
So, looking ahead, maybe things for listeners to track. How quickly can SAP scale up that AI agent roadmap? Those 40 agents by year end, what impact will they have?
Right. And also this whole digital sovereignty theme. How big does that become? Does it really reshape the investment landscape for enterprise software, maybe even broader tech, favoring companies with those specific capabilities?
Lots to think about there for the longer term. That's all for this deep dive from Talk Pickers. Thanks for tuning in.